There you go. Now I do. Okay. So, first of all, we have some issues with consolidating after the acquisition date. So this chapter first does the end of the first year, where nothing's been closed to retained earnings. And then they do, I believe it's 3 or 4 years later. Okay, so as we do a consolidation, we need to know two things before we ever start anything, even before the DDES. The first thing is, what method is the parent using to account for subsidiary? You say, well, duh, they should be using the equity method because they control, that's over 50%. Obviously, they should be using the equity method, but because it's easier, sometimes they don't. Because the end result, whether they're using equity, partial equity, or initial value, also called fair value, also called cost, the end result is the same. So why not take the easy way out? So many of them do. What we did, remember we had you're going to memorize the 4 T accounts, 2 for equity method, 2 for fair value and cost method, right? So sometimes the parents, I'm looking at these two because they weren't here, sometimes the parent uses those. It makes it easy. Just reports the dividend as dividend income and does nothing with the purchase price. Just leaves investment right there. So it stays there, right? On the cost method, the investment just stayed the same number. All right. The partial equity, the only difference between equity, what? Okay. Breakfast, okay. The only difference between equity and partial equity is there's no amortizations in partial equity. Okay? All right, so then after we decide which method the parent's using, that's step 1. Step 2 is how many prior years are there? Prior. Don't count the current year. How many prior years? And that's important for the A entry and the E entry. Okay? The third thing we do is we do a DDES. And then we write out our consolidation entries. And then we put them on the worksheet. So far, so good. All right, so let's see. So we did the first illustration, page 86, I believe. We did problems 1, 2, and 4. So I'd like to go to page 88. Sorry, my buttons are noisy. Page 88. And it says, here's an illustration. And we're going to go through this. 88 to...
Is that the one in the blue box? Which illustration is it?
Well, it starts on page 88. Halfway down, it says, as a basis for this illustration.
Mine doesn't I have the book that's on my laptop.
There's exhibit 3.1. That's not what I
Just hit
want.
the arrow up at the top next to the page number. It'll take you next to it.
Okay, cool.
Oh, thank you. On the ebook? Okay. All right, so it says, as a basis for this illustration, assume parent obtains all of the outstanding common stock of son. So parent is the parent. Son is the subsidiary. On January 1st, 2014. Did we walk through some of this? We didn't do this at all. Okay. And so they give us what they gave us in chapter 2, the book values, the fair values. Actually, we even have it. No, I guess it was chapter 2. And the difference, right? So we're used to this. They give us a DDES at the top of 89. Let's look at that. Book value. They added up the 3 equity, common stock, AFIC, retained earnings on January 1st, 2014, which was also 12/31/13. Okay. Determine the excess to be $200,000. Allocate the ones that we know, and that leaves us with an $80,000 goodwill. The bottom of 89. They do to the side. The trademarks don't amortize, they're indefinite. Okay. The patent 10 years, the equipment 5 years, and then goodwill indefinite. So far, so good.
I think we did look.
I think we did look at this.
I just saw it in my notes.
Yeah.
Okay. So the parent is using the equity method, top of 90. Well, we're just going to kind of review a little bit. The parent's using the equity method, so they do in their. This is actually recorded journal entries. They're not consolidated. allocation entries. They do that, and at the end of the year, page 91, and then we did the S, the A, the I, the D, the E, the P on pages 92 and 93 and 94. Okay? And we finished page 94. So, as a review, the S entry is, and we did the S and the A in chapter 2. The S is the same, subsidiary stock, but we want to debit the common stock and APIC of the subsidiary and the retained earnings at the beginning of the year, which you'll find on the statement of retained earnings, the middle section. So you see where the S entry is on page 94. They debited down the balance sheet part, common stock and APIC. But up in the statement of retained earnings part, the retained earnings on January 1st. Everybody with me? They added those three up and they credit investment in sum, $600,000. So they just added them up. The other side of SAID is the investment account. By the time we finish SAID, we should have a 0 in the investment account. We should have eliminated it completely.
And there will always only be one S on the credit side? One S entry?
Yes, unless we had a deficit, which is very unusual. Because common stock and APIC are always credits, and we're eliminating them. We're also eliminating retained earnings or deficit at the beginning of the year. Okay, and then the A is the allocations from the DDES, right? How we determined that excess, how we distributed the excess. And so since there are no prior years, it looks just like the DDES did. The A, the trademark was debited 20, patent debited 130, goodwill debited 80, and the equipment was overvalued, credited 30. We add those up, net those out, and we find that they are $200,000, which was our excess. Credit to investment. Okay, the new IDEP, the I, the source is the parent's income statement, and it's the account called equity and subsidiary earnings or investment earnings or whatever that is. It's that $93,000. Get rid of it. It's a credit. We need to debit it. And the other side, SAID, is the investment account. The D, we look for the subsidiaries' dividends, which is a contra equity account, so it has a debit balance. We're eliminating it, so we've got to credit dividends. So the source is the worksheet, the subsidiaries column, second column, in the statement of retained earnings, that $40,000, dividends. Get rid of it. And the other side, investment, SAID. The investment is now a 0. Investment earnings is now a 0. So far, so good. The E comes from that schedule to the right side of the DDES, or in this case, the bottom of page 89. The patent was $13,000 a year. The equipment -$6,000 for a total of $7,000. Here.
How did they know that the book value of the Sun Company was $200,000?
For this particular one,
It was just given?
no. There's book value equals net assets equals assets minus liabilities equals stockholders' equity. Remember that?
Yeah.
The 4 things? They use stockholders, well, actually, it was given, net book value was given to you, $600,000. It's also, they give you common stock, APIC, and retained earnings. So you could do it either way. You could look on page 88, there's $600,000, assets minus liabilities, or you could add up the equity accounts, 200 plus 20 plus 380 is $600,000. Either way, you get $600,000.
Right.
But remember those 4 things, because sometimes all you have is assets and liabilities. Sometimes all you have is equities. Sometimes they give it to you. Better?
Yeah, and if it's 100%, you don't multiply it by anything, right?
Correct. That's the difference. There's some things that are easier in chapter 3 than they were in chapter 1. You don't have to multiply it by 1% because it is, well, you do, but it's 100%.
Yeah.
And you don't have to multiply each of those allocations by 1% because we own 100%.
Okay.
Thankfully, you don't have to do chapter 4, which is less than 100%. doing that again. Okay. All right, so far so good. So the E then is we want to expense for this year. So there's a $13,000 debit to amortization expense and a $6,000 credit to depreciation expense. And then the offsets are equipment and patent. Okay? Whenever you have an A that's a debit, you either don't have an E, like for land or goodwill or trademarks, you either don't have an E, or if you have an E, it's on the other side of than the A. So look down, if you will, at trademarks. Since they have an indefinite life, there's an A with no E. You see, there's no E on that line. The patent, where you have an A as a debit, you have an E as a credit. The equipment, where you have an A as a credit, you have an E as a debit. Always. And then goodwill, indefinite life, you have an A with no E. So what you're doing is you're amortizing one more year, one more year, one more year. That's just the 1 year there. And you're putting it into, so you are actually adjusting amortization expense and adjusting depreciation expense. And you're adjusting the 130 and you're adjusting the 30 with your E. Okay? And then we came across and we said that all lines except for the double underline, you go across. So we did the 1.5 million plus the 400,000 is 1.9 million. Go across. Foot, you cross foot. But when you get to a double underline, you don't go across. You go down.
So for like.
So for that 693 there, that is down. It's the 1.9 credit, 932 debit, 165 debit, 110 debit equals 693 credit. It doesn't foot across because 693 plus 100 does not equal 693.
So
You follow what I'm saying? Do you see where I am?
So when we're taking the test, will it have the double underlines, or do we have to make that?
You got to make the double. Well, you've got them in your first,
Because didn't you say that we were going to be given the first two?
but I'll also have your lines, and I didn't do the lines for this.
Okay.
But you see the first two columns, you've got the double underline. You know
Yeah.
where they are. Just make your double underlines. I'll try to make sure I do that. Okay. And then what you do is you put it down, not across, and you just take that 693 and put it into the statement of retained earnings. You move it down. You just put it there. Because remember in principles that you had the bottom line of the income statement goes into the statement of retained earnings. And the bottom line of the statement of retained earnings goes into the balance sheet. So that's what we do. We foot the 693 down. Derek, you got it? Down, and then take that 693 and put it below. Then do the cross for the beginning retained earnings, the dividends, which is now just the parents. Just the parents. And then you foot down for that 1,413,000 and you take it and put it in the balance sheet.
So
Uh-huh.
we'll be given like all the accounts and stuff like that, and we just have to like change it like with the consolidation entries.
Yes, we're going to do several. As many as we can get done, we're going to do.
Is that going to be for chapter 2 and 3, or just 3?
Your problem for your test is chapter 3.
Okay. And I have a question for like on the review sheet. I always got confused. So if it's composition or with the COMP, does that mean that's the one you're writing it out, or is that the one where it's computational or whatever it's called?
COMP is computational.
Does that mean like it's like one of the long word problems, or is that the multiple choice ones?
Well, the ones that have the empty space right there,
Those are the.
they are short answer. You have 150 points on this test. 75 points is multiple choice and short, like prepare a schedule of equity income from subsidiary. That would be a short problem. That's part of your 75 points that goes with multiple choice. The one problem that you'll have is number 48 or 49. You will have a consolidation worksheet. So number 15, 16, 17, 18, 32, 33, 34, you'll have some of those as short problems. those are added to your multiple choice for the 75. The consolidation worksheet is the other 75 points. Exactly. And you can ask along the way. You want to choose, if they're using equity method or they're using initial value method. We've got 3 prior years. Write it down, show it to me, and I'll say yes or I'll say no. Show me your DDES. Right? Then do your consolidation entries. Show me those. And I'll be wandering around. So if it bothers you for somebody to look over your shoulder, get over it this time, okay? Because I will be looking over your shoulder. And if I see that you're screwing up, I'll say, whoa, 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 whoa. Right? Back up. Honestly, if you have practiced doing these worksheets and you've gotten pretty good at it, then you will make 75 out of 75. The only people who don't get a full 75 on their worksheet have not been practicing 100% of the time. If you know how to do it, I can catch your oops errors, and then you can get through it. Does that make sense? So you will have 100% of that 75%. But I can tell like that the people who didn't do except the ones in class. So you need to practice. That's why I gave you 5 of them. We're not going to get to 5, but you need to practice all 5. You need to get to where you can do this. And every time you add one, it's that much, it's the learning curve, right? Okay. Are we good now? So let's go to problems 9 through 11, 20, 24, and 26.
What page is that on?
On page 9, problem 9 is on page 124. We also said that there are formulas, and so we will sometimes just do the formulas. And the only thing weird about the formulas is that you have to remember that, like if I ask consolidated buildings, you'd want the DDES, you want parents, book value, or parents, in the first column, parents, book value, plus subsidiaries, book value, plus the DDES amount on the date of acquisition, minus all years of amortization to date. Whereas when we do our A entry, it's all prior years, and then the E takes care of this current year. So, for example, let's go back just for a second, go back to page 94. If I were to ask you, what is consolidated patents at 12/31/14? It would be the parents, 370, plus the son, 288, plus the DDES, 130, minus 1 year, 13,000, equals 775. If you'll look also over at page 100, patents on special equity again. I want equity 3 years later. Where's equity 3 years later? Do they have it? Initial value. Yes, page 97, please. What is patents on consolidated patent technology on 12/31/17? It'd be the parents, 540, plus the son, 420, plus the DDES, 130, minus how many years total? 2014, 15, 16, 17. 4 times the 13,000. Okay? So it'd be 540 plus 420 minus, or plus the 130 from the DDES, that came from the DDES a long time ago, minus 4 years of 13,000, which does equal the 1,038,000. The difference is that when you do it on the worksheet, it's 540 plus 420 plus 130 minus 3 years of 13,000 is 91 minus 13. Okay? Because you do this in the A entry, you do that in the E entry on the worksheet. which gives you the consolidated total of 1,038,000. If you were just doing the formula, you would do 540 plus 420 plus 130 minus 4 times 13, 52, and you would still get 1,038,000. So if you're asked like on compute consolidated land, well, there's no amortization, so it'd just be the parent plus subsidiary plus the DDES amount, because there's no amortization on it. Compute, well, that's kind of easy then. How about, well, I made it real easy. Okay, number 37 on your review sheet, consolidated equipment. If you don't have a worksheet, then you would do it this way. Okay? But if you're doing a worksheet, and you're also asked for the totals, then you do the worksheet, and then you could just pull it off the worksheet, or you could look at the worksheet and get the answers that way. It's the same thing, it's just that in the A entry, we do prior year's amortization. The E does the current year's amortization. There's 3 prior in December 2017, and 1 current. There's 4 full years. So this is the 4 full years. Got it now? Does that, once you see that clearly, it's not so hard, I think. Okay. All right, so let's go back to number 9, and let's do it, what did I say, page 124. On January 1st, 2013, Phoenix acquired 100% of the outstanding voting shares of Sedona. So Phoenix is the parent, Sedona is the subsidiary. You need to make sure you write that down somewhere so you know. $600,000 cash. At that date, they had net assets with a carrying amount, that's book value, of $420. So we have $180,000 is our excess, right? 620 minus 420 is 180. Equipment was undervalued by 80. The rest was attributed to a customer list with a 4-year life. So we're going to create that. And then apply the equity method, so we now know equity method. And each year since the acquisition, they've declared a $20,000 dividend, recorded net income 70 in 2013, 80 in 2014. They want to know, first of all, for 2015, what is consolidated net income? So we're using the formula way instead of the worksheet way. We want consolidated revenues minus consolidated expenses, which includes the E entry. Okay? It excludes that $55,000 income from Sedona, because that is the $285 minus the $195. Actually, it's real easy here to do it, because you could just add those 3 numbers and, no, you could, yeah, huh? 8, 48, no. What's 498 minus 405? No, it's not. 498 minus 350 plus 55.
That's 355?
498 minus 350 plus 55.
2, 3.
Yeah, that's the answer. Since they're using the equity method, and the equity method has already accounted for amortizations, I could have just done it that way, which I just did. But how do we normally do it? We do consolidated revenues, which is parent plus subsidiary, 498. Consolidated revenues, 498 plus, what was the subsidiaries? Revenues? 285. And you say, well, can't I just do it the easy way? Yes, but as we get into chapters 4, 5, and 6, no. And so we like to go back to the root, let's do consolidated revenues minus consolidated expenses. Okay, consolidated expenses are parents, which are what?
350.
And subsidiaries are? 195. Okay, plus our E. Well, to do the E, we've got to have our DDES, right? And so, let's get that going. Oh, they didn't do in number 11, they did the DDES, right? Okay, so for number 11, you've got the DDES. 600 minus 420 is 180 excess. And so, actually, I would have done it 80 and 100, and goodwill is 0, right? If we did it our way, it'd be purchase price or consideration transferred 600, book value 420, 180 excess, and they say that is equipment 80, and customer list is the rest 100, so that goodwill is nothing. Got it? I mean, that's the way we've been doing our DDES.
Where they get the 35,000 for amortization for the expenses.
We're getting there.
Okay.
Okay. And so the equipment has what year life?
Equipment has 8-year life.
Okay. 80 divided by 8 is, and 100, what is the life on the customer list?
4.
100 divided by 4 is
40.
25. So our annual amortization is 35. So we had to do the DDES to get the 35. Got it now? Okay, we did that, right? Which is consolidated expenses 580. So 783 minus 580 is 203. How's that? Did I lose you anywhere? Well, the answer is B, boy. 203. Questions?
On your DDDS, where it says 180 and then 100, is that second 100 supposed to be 180? Is that number right above
Yes,
the-
thank you. Yes, that should be 180. Yes, thank you. Talking, writing, thinking, walking. Right? But we did this. I mean, that's why I told you chapter 1 builds to chapter 2, builds to chapter 3, and believe it or not, chapter 4, 5, and 6, and 7 all build to. Yay! So, are we good with number 9? We ready to move on? Who needs a minute? Who's got a question?
So where did we get the 80? So the 80 is just because of
80's
the...
given.
Yeah. It's because it's 10-year life and it's 80,000.
Yeah, you gotta be able to do the DDS. That's critical. We've been doing that for 2 chapters. Okay, number 10 says, what is consolidated retained earnings? It's just the parent. So how much is it?
A.
8250, good. Because the S entry will eliminate the subsidiaries. It's just the parent. Number 11, on the consolidated balance sheet, what would they report for the customer list? At the end of, okay, so we ask ourselves, how many years? And this is the end of, it's January 1st, 2013, 14, and 15. It's 3 years. So if we're doing, so we would do the parent, the customer list is just the subsidiary, which would be this 100 minus 3 years of 25, right? So it'd be 25, CCAP. Now, on the worksheet, the A entry would be 50, 100 minus 2 prior years. And then the E would be the other 25. We'd be adding 50 in, 100 minus 50, and we'd be subtracting out 25. Good. switch over to number 20. They are independent situations. We're only going to do 20 for now. Hopefully we'll come back to 21 and 22. Page 128. They're based on the following data. Chapman obtains 100% of Abernethy. So Chapman is parent, Abernethy is subsidiary. On January 1st. As of that date, Abernethy has the following trial balance. So this is their book values, just in a different form. During the year, they reported net income of 80, declaring and paying dividends of 10. The next year, they reported net income of 110, declaring and paying dividends of 30. So the first one says, assume that Chapman acquired Abernethy's common stock for $490 in cash. And as of January 1st, Abernethy's land had a fair value of 90. What's its book value? 80. So there is an undervaluation of 10. I'll try to write a little less messy this time. They bought it for the price or the consideration transferred $490. What's book value? You can do assets minus liabilities, or you can do add up your equities. You notice there's no revenues, there's no expenses, so this is after closing 12/31/13. Right? It's easier for me to add common stock APIC. So APIC is 50, common stock is 250, there we're up to 300. Retained earnings is 100, so we're up to 400. So you could do that, or you could take your assets and subtract your liabilities, and you'll also get 400, right? Okay. Okay. And it says fair value of 90, its buildings were valued at 160, its equipment valued at 180. So, I don't like the way they did it, so we've got a $90,000 excess. And we said the first one was land, which was 10,000 undervalued. 90 minus 80. Everybody got that? Can you do that? So this fair market value is 90. You look back and see what it doesn't have the side by side right now. It's just a different form, but it's the same information given, just in a different form. All right, then it says buildings valued at 160. They're on at 120, right? So buildings are 40 undervalued. You with me? And then
Equipment at 180, but it's listed for 200.
okay, so it's overvalued by 20. The total of that is 30, so our goodwill is 60. Right? Again, they keep going back to different formats of doing this, but we're going to use the same one every time. Land doesn't amortize, but buildings and equipment do. So let's go out to the side here. Buildings have a
4-year life.
and equipment,
5,
a 4 or 40?
4
Buildings have a 4-year life?
remaining.
Ain't that a hoot? Okay, that's kind of screwy, isn't it?
24.
20 divided by 5, and remember it's a negative, is a negative 4, right? So our annual amortization is 6. Got it? Okay. Prepare the consolidation worksheet entries for December 31st, 2014 and December 31st, 2015. So now we're going to go through our setup. You ready? So before we've ever even gone to the worksheet, we've asked ourselves, which method are they using? Do you know? It says, uses the equity method. Okay, that's given. On December 31st, 2014, how many prior years do we have? How many prior years at December 31st, 2014?
No.
That's a big fat zero, okay? We have zero. Okay? So we need to know those two things before we go and do our setup. The S entry, we debit common stock of the subsidiary, AFIC of the subsidiary, and retained earnings beginning of the year of the subsidiary. So let's go find them. Now you say, oh my goodness, I don't have. Well, we have to assume that they didn't issue any common stock, and so that at 12/31/14 it's the same as it was at 1/1/14 for the first two, which are how much? Common stock is $250, AFIC is $50. But what is retained earnings? Well, we don't have that, so how would we do that? We do a T account. Retained earnings, we know what it was on the first of the year. It was 100. Retained earnings goes up for closing entries. Retained earnings goes up for net income and down for dividends. Always. That's since chapter 4 of your principles book. Retained earnings goes up for net income, down for dividends. Right? You know this. So what was their net income for the year?
For sure it's 80.
110.
Nope, the year before.
80.
80, and dividends?
10.
10. So on 12/31/14, oh, actually, I don't need that. What I need is the 100. Darling. Okay, I've got that. I need this though for the 2015 entries, sorry. Okay. And then my credit goes to investment, add them up, and that is 400. That's my S entry for 2014, because the retained earnings beginning of the year is acquisition date, Lynn. Okay. I'd like to say that I was trying to catch you, but see if you could, but that would be a lie.
And that, where you credit investment in subsidiary, that's a parent account.
Yes, it is. Investment in subsidiary, parent account. So keep this thought right here. I'm going to go ahead and erase it for now because it's in my way. But it's 170 on 1/1/15 when we do our entries for the next year. Okay. For the A, we go to our DDES. Our source is the DDES. We've got it right there. And so we debit and credit things like land for 10, and it's the DDES amount minus prior year's amortization. There are no prior years. So debit land, debit building, credit equipment, and then the net of that, oh, bless you, debit goodwill, don't forget my goodwill, right? Don't forget your goodwill, I almost did. And so that is 90, credit investment. This is a plug. This is a plug. SAID, it's a plug. Who needs a minute? The I entry, the source is the worksheet, but we don't have a worksheet. But on the worksheet, we would have the parents, we'd go to the parents, and the amount that they would have for the subsidiary's earnings. Well, they would have recorded their share of the 80,000, which is 80,000, 100% minus the amortizations, right? Think of your T accounts. What is investment earnings? Investment income is our share of net income minus amortizations. So that's what the parents would have on that line in the income statement on the worksheet, 74. You follow? And so debit, investment income or investment earnings or earnings in subsidiary, it is a parent account. It is in their income statement. It's a revenue account, and in this case, it's $74. And the other side, SAID, I said investment, which is also a parent account. Make sense? Questions? Because the parent has been recording, just like we did in chapter 1. They've been recording our share of net income, debit investment, credit investment earnings.
So it's your 2014 net income minus your.
Amortization. Just
per
think
revenue.
about those T accounts that we had in chapter 1. This is the right T account for the equity method.
Oh, okay.
The parent is using equity method, so they did debit investment, credit earnings for 80, and then they did the opposite, debit earnings, credit investment for 6, because they're using the equity method. So at the end of the year, it's 74. That's what's on their books. We need to get rid of it. So we're removing it. The D is the parent's share of dividends. So since it's 100%, we go to the dividends that they paid, and it says they paid 10. Dividends are contra equity, so if we're going to get rid of them, we got to credit. Dividends, I'm skipping a line. Credit dividends, 10, and debit, SAID, investment. You got it. SAID. Okay. And then the E is the expenses of amortization. It's this right here. And what we want to do is building needs to be, remember wherever you have, since we debited building here, we're going to credit building now. And since we credited equipment there, we're going to debit it now. Right? So debit equipment. It's 4. I'm skipping a line. Credit depreciation expense, 4. And then credit building, 10. And debit amortization. Oh, I guess they're both. I guess I could just do depreciation expense is for both, isn't it? Because there's no customer list or anything. So debit depreciation expense for the. You could do 2 of them, but you don't need to, right?
But you
Yeah.
could if you wanted to.
You could if you want to. It would just be 2 debits to depreciation expense. Not a big deal. How we doing? Tell me when you're ready to move on. Who needs a minute? Okay, let's do the 2015 entries. What's different? Well, what's different is the parent. Let's think about that T account that the parent has been doing. Remember, they started with the purchase price. They put in 80 and took out 10. Our share of net income, amortizations. So at the end of the year, it would have been 560, right? And you know what? If you add this up, 400 plus 90 plus 74 minus 10, you get that number. And it's gone, right?
Say that again. If you add.
If you
Yeah,
added the-
because what we're doing in SAID is eliminating this, this, and subtract that, you get that number. Always. That's not a coincidence, that's an always. That's its purpose, is take pieces away rather than do it all in one giant conglomerate entry, okay? But then what happens is, they have 110, so that we've got this much at the end of 12/30, or on 12/31/15, this is the number that we've got to eliminate, right? Because the parent's recording the equity method. They also have an investment earnings, or investment income, for that second year of 110 minus 10 is 100, yes? Okay, so let's see what's different here. First of all, the retained earnings at the beginning of the year, and I did that first. It's no longer 100. It's now 170. This is for 2015 now. So that's 470. What I have without the crossouts is 2014. What I'm doing now is doing 2015. The common stock and IFIC haven't changed. Retained earnings at the beginning of the year, which was the end of last year.
Where'd you?
I wrote that on the board before I erased it, the 170.
Oh, yeah, I understand. But I'm talking about the 10 under that one.
Emerson.
No,
Oh,
it
sorry,
goes to
6.
third.
6. This is 6. Dadgum. Help me here. Get me back on track. 6, 104, 6, 570, 564,
Yeah.
and then this one, 674, 668. Okay, thank you. Sorry about that.
And then for the earnings, because you end with 170, right?
Yeah, but then,
But then you ended with 170 for 2014. Then aren't you supposed to add the 110 that you're gonna get from
yeah, but
net
you
income?
close earnings every year. Earnings is a revenue, gets closed to retained earnings.
Okay, so you're gonna have the
So you
100.
start over with a new 110
Okay.
minus the 6.
Well, what about the dividends that you have to pay?
Dividends go in the investment. Oh,
But
did
I
I
thought.
forget my dividends?
Yeah.
Yeah, what I forgot, actually I had that right.
Then how come for when you were calculating your retained earnings for
Should be
2014, you
554.
you subtracted dividends? Because you said the only thing that changes retained earnings was in your,
Goes up for net income,
And
down for
you could-
dividends.
yeah, then how come you don't do it for retained earnings for that one? Because like you
You
did
do.
100 plus, for like, you know how you have earnings on, not the investment ones, but on like the whole the right T chart account? You
Yeah,
had 100.
dividends don't. Dividends are debit cash credit investment.
No, I understand that, but I'm saying like, to calculate how you got the 170, you had the 100 plus the 80 for net income, right? And then you subtracted the dividends from 2014,
Yeah.
and that's how you got 170.
Oh, but I also need to subtract my amortization, don't I? I'm trying to do a whole lot more to a problem than I should have done, yeah.
So for the 2015, you'd have to have the 110, and then you'd have to have the amortization and the dividends?
Yes, because they're doing full equity method. So, yeah, I really screwed that one up big time. Okay, so instead of 100, it's 164, I believe. Does that sound better?
Or,
Let me see. Yes,
Yes, it is.
okay. That's 15. No, it says 170.
because I don't know, you don't do the, what's it called, do you? You don't do amortization for earnings?
No, you don't do it for
Because, yeah, that's how, it's still 170, because you
yeah,
added that,
it'd still be
instead of the
170.
6, it would
Okay.
be a 30, because
Okay,
that's what happened.
all right. Well, let's just look here instead of me trying to cross these out. What I want you to know,
Confused me.
yeah, I'm very confused as well. What I do want you to know is that a year later, that is no longer 40. It's 40 minus 10 is 30. Your equipment is no longer 20, it's 20 minus 4 is 16. So that changes. Your investment earnings is not 74, it's the 110 minus the amortizations,
For the year, which is
6, which is 104.
right.
Your dividends is the same because they paid the same dividend each year. And your E is the same because none of the years have dropped off yet.
So basically,
My
just your
purpose
retained
was-
earnings is different, and you have to account for
Yeah,
all the
yeah.
This is,
Yeah.
Pardon?
Huh?
We'll get there.
yeah,
Okay.
alright.
Okay, let's go to 24. Let's put this one to bed. Let's go to 24. I'm on page 129. Following are selected account balances from Penske and Stanza as of December 31st, 2015. So this is at the end of the year. And it says underneath that, on January 1st, 2015, Penske acquired, past tense, all of Stanza's outstanding stock. So they're kind of doing it opposite. You know, usually they say, here's what we have January 1st, and then, okay, right? So this is the end, right? It's just different form. I just want you to get used to different forms. Okay. For 680 fair value in cash and common stock, they also paid 10,000 stock issuance costs. You know that's going to be a debit to APIC and a credit to cash. At the date of acquisition, copyrights have a 440 book value but a fair value of 560. So on 24, let me show you their DDES rather than take the time to do it. But if you're not quite there yet, go back and make sure you can do it, right? So here we've got the amount paid, the stockholders' equity balance, the beginning of the year. And how did we get that? It's got retained earnings January 1st, 2015 of 200. And then it's got APIC at the bottom of 80 and common stock of 200, right? 200, 200, and 80. You with me? Book value equals stockholders' equity equals assets minus liabilities, but we can't do that here with assets minus liabilities because we've got revenues and expenses to mess it up. Okay? Is in excess of 200. There's a copyright 120 and goodwill, and that 120 amortizes for 6 years is a 20. That's your E. So far, so good. So we got the DDES, piece of cake.
So if it's, to calculate the book value, if it's not 100%, can you still just add the APIC, the common stock, and the retained earnings to find book value?
Yes, as long as you've got it on the right day.
Okay.
And we had retained earnings January 1st, which was the date of acquisition.
And do you want me to start this one over?
Yeah, let's